Hello, today we are going to discuss mortgage payment options. We have the most commonly considered options of a 30-year mortgage versus a 15-year mortgage. So I am absolutely going to cover those options and show you what the difference is on a fairly standard purchase price and home value. The third option is something that we're also going to cover so you can compare, contrast, and this third option I recommend to the majority of my clients as an alternative of going with the 15-year mortgage. So I don't hate a 15-year mortgage. It's just that the payment of the 15-year mortgage is generally hard to commit to for the majority of folks who are looking at financing options. So here we have this scenario, property value of $400,000. By the way, we're using Carl's Mortgage Calculator. That's the app that I use on my phone as a real estate agent. I use that all the time to help my clients with payment estimates and to kind of run through this scenario with them case by case. On the internet, you're going to find it, or on a web browser, you're going to find it here on this web address. Now, back to the property and the details. Property value of $400,000. Down payment of 20%. This is basically just so I don't have to calculate PMI and give you estimates there, so we can be as accurate as possible here. This is the principal you'd be financing, your interest rate. This is pretty average, 6.35 right now. This is October of 2024. We're going to say your start date for your mortgage is December 1st of 2024. 30-year mortgage, this is what we're looking at. The payment for principal and interest is here. We got to this number for expenses by my estimates of $1,500 per year in homeowners insurance and $7,000 per year of annual taxes. That's pretty accurate for the Northeast Ohio area where I'm located, where I do business. This may need some adjustments for your area depending on what you're looking at on average. But the loan data, the interest rates, all in the payment schedule, this is all going to be very accurate. Now we're looking at a total payment over 30 years of $2,700, we're going to say. This is the ugly number here. The total interest paid, $396,000, almost $397,000 of interest over 30 years time. So simple comparison. This interest rate, if you're going to do a 15-year mortgage, okay, keep in mind that number, $397,000. So if you're going to go to a 15-year mortgage, your interest is going to go down significantly, and your interest rate is going to also likely go down. So I'm going to just use 5.75% as a rough estimate as to what this scenario would look like on a 15-year loan. So nothing else has changed, only the term and the interest rate. Now, this is a much more attractive number. What do we cut out? More than $200,000 of interest. But what also happened was we went from $2,700 to $665 more per month. And you have to commit to this. If you can't make that payment, you are in trouble. You're facing default on your property. This is why I like option number 3, and this is why option number 3 is easier to swallow for most people than committing to a 15-year loan at a payment that takes another $665 out of their bank account every month. So let's discuss that. Now we're going to keep this in mind. We had $397,000 of interest or $158,000 of interest. But again, a $665 difference. And that's a commitment. So this is what I normally suggest to most of America. Okay, we're going to go back to the scenario of the 30-year loan. Because now we're committed to $2,700 a month. If we can't make that payment, we're in trouble. Just like we were before. But our interest is way up here, $397. We don't like that. So we're going to try our best. We're going to expect that we can help ourselves most months. We're going to say, hey, we're going to commit to this, and if we get in trouble, then we can adjust. So my suggestion is you take $1 for every $1,000 that you have borrowed, and you make that as an extra payment every single month. So you're going to want to commit to that, $320 per month as an extra payment starting month 1 and going until you're finished paying your mortgage. See what happens here? We've reduced your mortgage term by 9 years and 2 months. Okay, so now instead of paying over 30 years, you're done paying on your mortgage in just over 21 years. The total interest, much better than $397. Okay, we've saved you $140,000 of interest. We didn't get down to $158,000. Okay, so we're still $100,000 more. Now that's ugly, we don't like that. But again, this is why this is the suggestion, because your total commitment is $2,700 a month. You're actually paying $3,020 a month because we're paying the extra $320 each month. So $3,020 versus $3,365, which was the 15-year mortgage payment. And again, the big difference is this is your total commitment. So if you have some sort of hardship, money gets tight for a little bit, this is your safety net, $320 of safety that you can choose to remove from your payment scenario because it's not a commitment. It's just your best case scenario. And that is going to help you save, in this case, $140,000 of interest, and it's going to reduce your mortgage term by 9 years and 2 months. So I'm sorry, it's just under 21 years that you're paying on your mortgage for. This is my suggestion as a real estate agent. Again, I do this where it makes sense to do it. Right now, I've restructured some things because I do own several properties, and it makes more sense to let my tenants pay off principal, and I use the funds for more investments. So follow me if you'd like to get advice on any and all things real estate. Reach out if you have specific questions. I'd be glad to help. That is the goal. Have a good one.